This is Alan Bush with the Daily Financial Forecast for Thursday, September 8th. Starting out with the stock index futures, we did see some gains in the overnight trade. This linked to ideas that the Fed may be very slow to raise interest rates. Now, we do have an upcoming Fed meeting on the 21st, and the probability of a rate increase now down to 18%. Earlier in the week, it was as high as 27%. So that helped the market earlier, but more recently, some pressure developing, which looks more like long liquidation, possibly some type of profit taking. Also, the volume appears to be relatively light. So I think that we will see some recovery later today. Still thinking longer term that the main trend is higher for all of the major stock index futures. Now, moving over to the currencies. The main event today was the European Central Bank's policy meeting, in which the ECB decided to leave interest rate policies unchanged. In fact, their entire stimulus program was left unchanged. There was a slight chance that they could have announced more stimulus. So an unchanged program means firmer interest rates in the Eurozone, and that translated into a higher euro currency. In fact, most of the European currencies tended to be supported by the lack of action from the ECB. So by the same token, with the euro currency a little higher, that puts some pressure on the US dollar index. Longer term, we do think that the dollar will probably hold up relatively well, and I think the dollar will probably trade sideways to higher. However, we are seeing the interest rate differential advantage diminishing to some degree, so only be a buyer of the dollar index on hard breaks. I would much prefer to be trading alongside of other markets such as stock indices and precious metals, which we'll get into a little bit later, at least as far as the metals. Also some gains in the Australian dollar. This after better economic trade data coming out of China. So Australia is often seen as a proxy for what is happening in China as far as the Australian dollar movement is concerned. So the Australian dollar will probably hold up relatively well if we are right in our thinking that China is in a recovery mode, even though it may be a very slow improvement. We do believe China has turned the corner. So the long side of the Australian dollar, I think, is the right way to go. Now, moving over to the interest rate futures markets, pressure developing, especially at the long end. Some of this linked to higher energy prices, but a weaker stock index market is not supporting the bond market. That should be viewed as a sign of weakness. We also believe that global inflation is going to gradually increase and will tend to work higher at an accelerating rate in the future. So that should be the main negative for the 30-year bonds. And we do feel that the 170s support area in the September bond futures, which has held quite a few times, will not hold indefinitely. And within the next week or two, I would look for that support to be penetrated on the downside. Gold and silver still look like vehicles that should be traded from the long side. If we are right about our inflation outlook, gold and silver should be the prime beneficiaries. So any weakness in the precious metals should be viewed as a buying opportunity. So good trading, everyone. Once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.